can do is try to grow and open the second, third, and fourth locations. Those sorts of businesses tend to require an owner's touch and normally cannot grow in the same way as a McDonald's could, following a formula to punch out restaurant after restaurant after restaurant. Investing in the second kind of business is fine. You just need to know what you are getting into and to expect your return to come from dividends and returns of capital rather than reinvestment compounding. The worst kind of business in the world is one that doesn't make very good returns on capital, but needs more of it all the time. We call those airlines and try to make sure we don't invest in that sort of thing at all.
The insurance industry in the United States is over $500 billion in insurance premiums. Worldwide, the number's probably twice that size. Over the past century, insurance premiums as a share of gross national product has consistently grown. With only $2 billion in premium revenue at Markel, we're still very small and we've got a lot of room to grow. And yet, with $2 billion of premium in the specialty marketplace, we're big enough to be meaningful in most of our markets. As our society grows and changes, new insurance risks come into being every day. Directors and officers insurance or employment practices liability insurance did not exist 30 years ago. And this evolution of new products in the insurance market will undoubtedly continue to grow as our society continues to grow. At Markel, our ability to continually reinvest in our expanding specialty insurance business, both through new products and geographically, is a wonderful growth opportunity.
The fourth and final screen I use is price. I'm looking to buy businesses that pass the first three tests at fair prices or better. And the way I define a fair price is one that allows me as an outside shareholder to earn the same sort of return that the business itself earns intrinsically. My main attempt is just to make sure that I don't overpay so much for something that even if the company produces the earnings I expect, the stock price might not reward me because I just paid too much for it. If a company grows at 10, 12, 15% a year for a 5-year period, a fair price means that I, as a shareholder, should earn at least the 10, 12, 15% that the company did. If I pay 40 times earnings going in, I am unlikely to get that return since that's just too high a price. If I pay 10 or 15 times earnings going in, I've increased my odds dramatically that if I was right on the other parts of my thinking, then I should earn the matching or better returns as a shareholder.
Historically, Markel stock has traded between 1.5 and 2 times book value. The price of the stock peaked last fall at almost $550 a share, which at the time was slightly in excess of twice book. And today, with the stock down about $300 a share, it's trading at somewhere around 1.3 times book. As managers, we have little, actually no, control over the short-term market swings in the stock. But what we can do, and what we consistently will do, is to focus on building book value per share over the long term. And with superior underwriting and excellent investing, we can achieve this goal.
I hope you noticed that the elements we described really didn't talk much about the economy, interest rates, oil prices, commodity prices, foreign exchange rates, and the price of gold or geopolitical situations. While they are all hugely important items, they're out of our control and not dependably predictable, in my opinion. They are important top-down pieces of information, but they are not knowable in advance. Therefore, we try to distance ourselves from thinking about them as much as possible. I also hope you notice that all the things we talked about carry an implication of the passage of time. We think a good business is one that should last for a long period of time and produce results for investors over time. There can be a real disconnect between the agenda of a management team that has an appropriate long-term view of its business and is acting as a reasonable steward, and much of the activity that goes on in the investment markets. We happen to think at Markel that we can build a business over the long term which will reward investors fairly and appropriately. By contrast, what we've talked about are things that are more in the control of the companies and the managements. It's a bottom-up approach to looking at investing rather than from a strong top-down view. Our belief is that if we are right about identifying and running profitable businesses with good returns on capital, with people who are both talented and honest, with reinvestment opportunities and capital discipline at fair prices, then things will work out just fine for both the company and the investment portfolio. We think this approach is timeless and works during both turbulent and placid times. A friend of mine, in response to a request to write something that would be relevant 500 years from now, said, "This too shall pass." Our current turbulent times will pass, and the waters will calm. The economy will recover and prosper, as it always has and always will. We hope that we've given you a clear picture of how we go about investing and managing at Markel, and we would now be pleased to answer your questions. Thank you.
Okay, the rules are the same. Please address the mic.
I'm a first-year guardian. Do you guys anticipate increased regulation that may affect your investment strategy? And if that increased regulation has a negative effect on your returns, do you anticipate being able to pass through those costs as increased premiums to policyholders, or is it going to affect the bottom line?
From an insurance perspective, there are very few regulations in our business that affect how we invest the money, so long as the securities we invest in are sufficiently liquid that we can meet the claims of our policyholders and that we value them in an appropriate way. For Markel, virtually every security we own is marked to market based on the New York Stock Exchange or a fairly liquid bond exchange, and so the valuation issues for our portfolio are very, very simple and are not very burdensome. Where additional regulation could conceivably come in is as regulators look at risk-based capital, they may require larger capital allocations for companies that invest in equity securities and that type of thing, which would maybe affect the balance of securities a little bit. But for the property casualty industry, I would not expect new regulation to make much difference. Might be very different in the life business, and certainly it could be different in some other areas of the economy, but I don't think property casualty insurance, it's a big exposure.
I would also add, you used the phrase pass through in your question. Insurance by definition is a pass-through mechanism. We're paying claims for what happens out there. We're collecting premiums to cover that. And if part of the costs of paying claims and operating a business is higher regulation, we, as will every other company on the face of the earth, have to include that in the cost structure to pass through to consumers.
Any other questions? I want to thank Tom and Steve. Thank you very much.